Section 1. Economic Crystal Ball, Decoding the Surprise Index. The Economic Surprise Index may sound like something out of a fortune teller's tent, but it's actually a closely watched indicator used by economists to gauge the health of the economy. This index is not just a random number, it is derived from a complex analysis of various economic reports and data points. Economists and analysts pore over these numbers to understand the underlying trends and shifts in the economy. Think of it as a barometer for economic data. Just like a barometer measures atmospheric pressure to predict weather changes, the Economic Surprise Index measures the pressure within the economy to predict its future direction. When the index is high, it means that economic data is coming in better than expected. This can be a sign of a robust and growing economy, where businesses are thriving, employment rates are high, and consumer confidence is strong. Conversely, when the index is low, it suggests that the economy is underperforming expectations. This could indicate potential issues such as slowing growth, rising unemployment, or declining consumer spending. This index is important because it provides a real-time snapshot of how the economy is performing relative to forecasts. It helps to bridge the gap between what was expected and what is actually happening, offering a clearer picture of the economic landscape. It's a valuable tool for investors, policymakers, and businesses trying to make sense of the economic landscape. Investors use it to make informed decisions about where to allocate their resources, while policymakers rely on it to craft effective economic policies. Businesses, on the other hand, use it to strategize and plan for the future. Right now, the U.S. Economic Surprise Index is sending a clear message, and it's not a good one. The index has been on a downward trend, reflecting a series of disappointing economic reports. The index has been plummeting, indicating that economic data is consistently falling short of predictions. This persistent underperformance is a cause for concern, as it suggests that the economy is not as strong as many had hoped. This suggests that the economy is losing steam, and may be headed for a downturn. The signs are becoming increasingly clear: slower growth, potential job losses, and reduced consumer spending. This sudden decline has sparked concern among economists and investors alike, raising questions about the future trajectory of the U.S. economy. They are now debating whether this is a temporary blip or the start of a more prolonged economic slowdown. The coming months will be crucial in determining the path forward, and all eyes will be on the Economic Surprise Index for further clues. Section 2. Freefall. The index takes a nosedive. The recent plunge in the U.S. Economic Surprise Index is impossible to ignore. This index, which measures the difference between actual economic data and economists' expectations, has taken a dramatic turn for the worse. It has fallen sharply, signaling a significant deterioration in economic conditions. This sharp decline is a clear indicator that the economy is not performing as well as many had hoped or predicted. This nosedive is driven by a string of disappointing economic data releases. Each new report seems to bring more bad news, compounding the sense of economic malaise. These reports paint a picture of an economy struggling to gain traction. From manufacturing to retail, the signs of strain are becoming increasingly evident. For instance, job growth has slowed, inflation remains stubbornly high, and wages are not keeping pace with the rising cost of living. This combination is putting a squeeze on both businesses and consumers. And consumer spending, a key driver of economic growth, has weakened. When consumers cut back on spending, it creates a ripple effect throughout the economy, affecting everything from small businesses to large corporations. These data points, taken together, suggest that the economic recovery may be faltering. The initial optimism that followed the reopening of the economy is giving way to a more sobering reality. The surprise index is sounding the alarm, and it's time to pay attention. Economists and policymakers are closely monitoring these developments, as they could have far-reaching implications. This confluence of negative data has rattled markets and fueled fears of a recession. Investors are becoming increasingly nervous, and stock prices have been volatile as a result. The question on everyone's mind is whether this downturn is a temporary blip or a sign of deeper economic woes to come. Some analysts believe that the economy will bounce back once certain issues are resolved, while others warn that we could be in for a prolonged period of economic difficulty. Experts are debating potential policy responses to mitigate the downturn. Some advocate for increased government spending to stimulate the economy, while others call for tax cuts or monetary easing. Global economic conditions are also playing a role. Trade tensions, supply chain disruptions, and geopolitical uncertainties are adding to the challenges faced by the U.S. economy. Small businesses, in particular, are feeling the pinch. Many are struggling to stay afloat amid the economic uncertainty, and some have been forced to close their doors permanently. Consumers are also expressing concerns about their financial future. With job security in question and costs rising, many are worried about making ends meet. Policymakers are under pressure to take action. They are exploring various measures to support the economy and prevent a deeper downturn. Economists are analyzing the potential long-term impacts of the current situation. They are considering how prolonged economic weakness could affect everything from employment to investment to overall economic growth. Financial markets are reacting to each new piece of economic data. The volatility is a reflection of the uncertainty and concern that pervades the current economic landscape. In summary, the U.S. Economic Surprise Index's nosedive is a stark warning. It highlights the challenges and uncertainties facing the economy and underscores the need for careful monitoring and responsive policy measures. As we look to the future, the key question remains: will the economy rebound, or are we headed for more difficult times ahead? Only time will tell, but one thing is certain: the current economic landscape requires vigilance and adaptability. Section 3. Recessionary Echoes. Past as Prologue. The current trajectory of the Economic Surprise Index is eerily reminiscent of past economic downturns. This index, which measures the difference between actual economic data and economists' expectations, has been a reliable indicator of economic health. When the index is positive, it suggests that the economy is performing better than expected. Conversely, a negative index indicates that the economy is underperforming. History shows that sharp declines in this index have often preceded recessions. For instance, in the lead-up to the 2008 financial crisis, the Economic Surprise Index plummeted, signaling trouble ahead. Similarly, before the 2001 recession, the index took a sharp downturn, foreshadowing the economic challenges that were to come. For example, similar plunges in the index occurred before the 2008 financial crisis and the 2001 recession. These historical instances highlight the index's predictive power and its ability to signal economic distress before it becomes apparent in other indicators. While the past is not always a perfect predictor of the future, these historical parallels are difficult to ignore. By examining the patterns and trends that preceded previous recessions, we can gain valuable insights into the current economic climate. This comparative analysis allows economists and policymakers to identify potential warning signs and take preemptive measures to mitigate the impact of a potential downturn. They serve as a stark reminder that economic indicators can provide valuable warning signs. By paying close attention to these signals, we can better understand the underlying health of the economy and make more informed decisions. Ignoring these indicators could lead to a repeat of past mistakes, resulting in severe economic consequences. The current decline in the surprise index, coupled with other worrying economic data, suggests that the risk of a recession is elevated. Factors such as rising inflation, supply chain disruptions, and geopolitical tensions are contributing to the economic uncertainty. These elements, when combined with the declining surprise index, paint a concerning picture of the future. This historical context adds another layer of concern to the already gloomy economic outlook. By understanding the patterns that have led to past recessions, we can better anticipate and prepare for potential economic challenges. This knowledge empowers us to take proactive steps to safeguard the economy and minimize the impact of a potential downturn. The question now is whether the U.S. can avoid repeating the mistakes of the past and avert another recession. By learning from history and heeding the warning signs provided by economic indicators, there is hope that we can navigate these turbulent times and emerge stronger. It will require careful planning, decisive action, and a willingness to adapt to changing circumstances. The future remains uncertain, but with the right approach, we can strive to build a more resilient and robust economy. Section 4. Wall Street's Reality Check: Optimism Confronts Data. The recent downturn in the Economic Surprise Index has exposed a growing divide between Wall Street's optimism and the harsh realities of economic data. For months, many economists and analysts have maintained a rosy outlook for the U.S. economy, pointing to strong corporate earnings and a robust labor market as signs of continued growth. However, the plummeting surprise index, coupled with a slew of disappointing economic reports, is forcing a reality check. The data suggests that the economy is not as healthy as some had hoped. This disconnect between expectations and reality is creating uncertainty in the markets. The question now is whether this dose of reality will be enough to temper Wall Street's exuberance, or if the disconnect between perception and reality will persist. Section 5. The Fed's Balancing Act, Taming Inflation, Averting Recession. The Federal Reserve, tasked with maintaining price stability and maximizing employment, faces a daunting challenge. The central bank is caught between a rock and a hard place. On one hand, inflation remains stubbornly high, requiring continued interest rate hikes to cool down the economy. On the other hand, aggressive rate hikes risk tipping the economy into a recession. The Fed's response to the current economic uncertainty has been cautious. It has signaled a willingness to slow the pace of rate hikes, but remains committed to bringing inflation under control. However, the Fed's balancing act is becoming increasingly precarious. The economic surprise index is flashing warning signs, and the central bank must carefully calibrate its next moves to avoid a hard landing for the economy.